So we were going to, I guess, center our focus a little bit for the first of these two panels that are about to happen. Talk specifically about shale gas, and up here we have three very distinguished speakers. We're going to go in order of the program. I'll go ahead and make some brief introductions now. The way we'll operate the panel is each of the speakers will get up and say their bit. And then we'll have some time at the end to deal with any questions and comments that you might have. So please just make note of whatever questions you might have, and we'll address them at the end in a discussion format. Our first speaker will be Arthur Berman. He's a petroleum geologist and consultant who specializes in prospect and play evaluation, reserve assessment, risk evaluation, subsurface geological and geophysical interpretation, and database management. He's got a lot of experience in the industry. For those of you who follow the shale gas discussion, you, I'm sure, have heard of him. He's probably one of the most vocal critics of a lot of the very, I guess, optimistic views that have been put forth with regard to break-even prices and just overall well economics in shale plays. So it'll be interesting to hear what he has to say. Next will be Terry Engelder. He's a leading authority on the Marcellus Shale. He's devoted a career really to its study, and he's currently a professor of geosciences at Penn State. He's also, and Terry, I hope I'm not incorrect in saying this, he was named one of Time Magazine's top 100 thinkers in a special issue.
Foreign Policy Magazine.
It was Foreign Policy Magazine. There we go. There we go. Time is the cover. That's what I'm thinking of. Okay. That's right. And he will also be addressing shale gas with respect, I think, to Marcellus in particular. So. Leading authority on the subject. And he'll be followed, last but not least, by Raul LeBlanc. He's a senior director at PFC's Energy's financial advisory practice. His extensive experience on issues related to North American independence and the natural gas market developments. And he has a lot of experience in strategic planning efforts and directing those efforts at companies such as Anadarko, and it will be interesting to hear what he has to say on this issue as well. So with that, I will turn the floor over to Art.
Well, thank you for that introduction, Ken. I'll introduce my topic, which is called U.S. Shale Gas Magical Thinking and the Denial of Uncertainty. And I mean that title both literally and metaphorically. If you take nothing away from this discussion and my talk today, it's simply that there is a lot more uncertainty as far as the economics and the ultimate reserves and the supply in shale gas, and I don't say that as a partisan one way or another. I'm in the business. I drilled natural gas wells. I evaluate prospects for my clients, and that's my take. So what I'm going to do this afternoon is really address the issues that people ask me about all the time when I give talks like this, and so rather than necessarily try to put out a position, although you'll hear it, try to address the burning questions that people ask. So let's see if I can figure out how to make this work. There we go. Well, I'll start out with a quote from the Tao Te Ching, which I'll let you read yourself. But basically what it says is when things seem too easy, they're probably really not. I've been in this business for 34 years. Finding oil and gas is pretty hard, and all of a sudden, 5 years ago, it got so easy that anybody can do it. So one who thinks that everything is easy will encounter much difficulty. What most people believe apparently that less is more. In other words, we can produce more oil and gas from shale than was produced from better reservoirs over the last 100 years. Most people believe that the United States has enough natural gas to last at least 100 years. If we did, I don't think that's an excuse to squander it as quickly as we can, but that's another topic. We have a shale business model, unlike any business model on the planet. There are no barriers to entry. Anybody can go out and buy a lease and drill a well. No barriers to entry except capital. There's an infinite supply of something that you have to sell cheaply, and yet everyone makes a big profit. If you can find a business like that, sign me up. Shale plays can make a profit at less than $5, and in fact, the cost, it keeps going down. I was on a panel with a fellow who stated that his company can make a very good internal rate of return at $2.57 per MCF exactly. I work in an oil and gas company where I do all the geology, geophysics, engineering. There's the owner of the company and 2 clerks, and we can't afford to drill a well for $2.57. Maybe we're just dumb. Gas prices are going to be low forever because of abundance and the low break-even price. And if any of that doesn't make sense, the fact that big companies are involved in this must mean that they're making money, just like Lehman Brothers and Bear Stearns and AIG did a few years ago. And finally, how can you say this isn't successful when we're producing so much gas? Well, I'm not here to deny big production, but big production volumes and money are not necessarily in the same sentence. What few people realize is that gas is not as abundant or as inexpensive as commonly believed. We don't have 100 years of gas. We got something like 20. That's a lot, by the way. Resources are not reserves, and reserves are not supply. And people who are not in this oil and gas industry, I don't expect should necessarily know that, but there's a huge difference between those 3 categories. I think that shale gas reserves are overstated by at least 100%. That means they're twice as big as I think they are. The true break-even cost of shale gas is about $7 per 1,000 cubic feet. That's not an opinion. That's stated in public filings to the Securities and Exchange Commission by the companies that participate in these plays. The present price has got to rise long-term for people to survive. The production is impressive, but most of the wells are not profitable today. All plays have contracted to core areas that are a fraction of the size of the play as originally advertised, and that doesn't necessarily mean that you take whatever that fraction is and multiply it by the original reserve number, but it does mean a significant reduction. And the shift to liquid-rich shale plays will deflate the gas oversupply over time and cause prices to rise, which I think is a good thing. And environmental problems, I think, are going to severely limit the development of the Marcellus Shale. I'm not saying they should, I'm just saying I think they will. Well, this is a table that I won't bore you with. It comes from the Potential Gas Committee, which is one of the more reputable or among the reputable organizations that tries to estimate technically recoverable resources, okay, not reserves or supply. And if you go through their numbers, what they basically say is, yeah, we got a great big number that's, 2 trillion cubic feet of technically recoverable resources. That's every molecule that's in the ground. But if you turn the page and you talk about the probable amount, the total probable is 550 trillion cubic feet of gas, which is still a ton. I make the very optimistic assumption that half of that will become a reserve. In other words, commercial. You add it all together and you count improved reserves with that and you get 22 years. Now, is that the right number? Well, of course it's not the right number, but it isn't 100 years. And again, this is not my opinion. I mean, this is what the Potential Gas Committee has published. That doesn't mean they're right either. So how does this happen? Well, the myth of 100 years of gas comes from confusing resources with reserves. In other words, possible reserves with reserves. It also assumes flat consumption. And a growing number of my clients are electric power producers, and whenever I show this slide, they all stand up and say, wait a minute, consumption's growing at 2.4 BCF a day per year, and we think it's going to grow a lot more when the EPA gets done with coal. They may be right. Well, this brilliant slide is one that I stole from our session chairman, and I like it because it shows the relationship of resources, which is the biggest ellipse, to technically recoverable resources, to probable resources, to reserve, and I added in supply. So reserves are really a very small set of resources, and they take years of development drilling to become supply. And by the way, an awful lot of our so-called proved reserves of natural gas are in a category called proved undeveloped, which means that nobody's drilled them yet. So they may or may not ever be developed. People ask me all the time, why do you think that reserves are overstated? I mean, all these big smart companies say one thing and you say another. Well, I'm a scientist. I look at data. Part of my expertise is in forecasting reserves. And the simple answer is it's all about the decline rate, people. This is the total horizontal well population for the Barnett Shale, which at the time I made this was about 10,000 wells. And all I did was I said, I'm not going to add any new wells in for 12 months and just see how those 10,000 wells decline on their own. And the answer is precipitously, 44% annualized decline. What's that mean? That means that you never get to stop drilling. If you want to keep your supply up or even flat, you've got to drill all the time. People say, but look at all these type curves, all of these things that get published in all of these investor presentations, and they sure look good to us. Well, you know, they look pretty good to me also, but this is what I deal with every day of the week. And here's an example of, I don't know what it is, I think it's some Barnett Shale wells, and my engineer that I work with, we looked at it and said, wow, you know, those are some pretty healthy estimated ultimate recoveries. It's about 2 BCF per well, which is more than any of the others that we looked at. So we said, well, let's do the same process of declining, just projecting how we think they're going to decline for all of the individual wells that make up this population, this type curve. Lo and behold, we found that the type curve over-predict remaining reserves by 42%. So there's obviously a problem with the averaging that goes on in type curve kind of work. We found that the curvature of the projection, which makes a big difference, was overestimated by 400%. Now, I don't expect a lot of you in this audience to care, but pay attention because this is the key to the whole thing. This so-called hyperbolic decline, which says that the decline rate keeps getting flatter and flatter and flatter, is the whole basis for this prediction of abundance. And there's absolutely, I won't say absolutely, there is no tangible proof that this is the way these wells are going to decline. They may, but we don't have enough history with these things to know. If that isn't right, then it's lower than I think, because I use hyperbolic declines. I just don't use ones that are as strong as everyone else does. So that means the wells won't last as long. And there's another phenomenon I'll talk about here called survivorship bias in a minute. Peer-reviewed papers, dozens of them in the Society of Petroleum Engineers, caution, don't use these very high hyperbolic curvatures. You know, the word hyperbole in Greek, it means two things. It means exaggeration and it means joke. Okay, these guys know it. Now, this is very important. This is what the SEC thinks. The standard for reserves is something called reasonable certainty. That means it's more likely to work out this way than not. It's not a model, and it's not what you prefer, and it's not what you can make fit the data. It's what you think is reasonably certain, and we haven't gotten there yet. Well, this is what survivorship bias is about. What this shows is a certain company, and we're looking at, in blue, their production decline, which is getting very, very flat, just like the models say. And the red is the number of wells that are making up those average populations. And what you see is that by the time you get down to a number of wells that's less than half of what you started with, probably the rest of that curve is completely irrelevant. And particularly if companies are out there doing re-stimulations and, you know, working over the well, which is perfectly fine, and they should do that, but that's going to artificially lift. Basically, what a survivorship bias says is that if we take the average age of everybody in this room, you know, it might be, I don't know, say 50. And if I just take these 5 guys over here, and one of them happens to be really old, and the rest are all about 50, he's going to bring the average up to 60. That's survivorship bias. It's the influence of a strong member on a small population. That's part of the problem. Well, this is an interesting case here in Texas. This is a property that a certain company paid an outrageous amount of money for, $20,000 an acre, anticipated $750 million of project development costs to get 450 BCF of gas, almost 500 billion cubic feet. At the end of the day, from what we're looking at right now, the average well is, it's going to be maybe a quarter of the reserves with the current wells. The average well is going to be an abysmal 0.9 BCF. That's just grotesquely non-commercial. So, you know, big companies know what they're doing except when they don't. The Haynesville Shale. This is an interesting play. This is sort of the granddaddy of the shales so far. The Marcellus will probably overtake it, but these are wells that typically come on for 10 or 15, million cubic feet of gas a day. We modeled this thing. We said 3 BCF a well, and that's about it. We got eggs thrown at us by the whole industry. We've done some projections here. If you believe our numbers, that says that even on a point-forward basis, in other words, not counting your land costs and a lot of your infrastructure costs, this play will not be profitable until gas prices get to almost $7. As of this morning, they were somewhere below $2.50. Well, then a few weeks ago, some people at Louisiana State University, the Haynesville's in Louisiana, came out with a study, very comprehensive, which, what a surprise, they said that production growth only continues in the Haynesville because we're drilling so damn many wells. 80% of the reserves, 80%, come in the first 2 years. That's the kind of decline rate I'm talking about. They said that the most likely case for an average well is 3 BCF. What a coincidence. They're projecting that the total production for the field will be, most optimistically, 9 TCF. I think that's low, but remember, this was advertised as a 250 TCF field in 2006. This was going to be the biggest gas field in North America. This is what uncertainty looks like. Costs are understated. Again, this comes out of company reports and SEC filings. This is just a series of some of the big players. They say they can make money at $5. That's not what they're telling the government. They're telling the government that their average break-even price is $6 or $7. Which is it, guys? I mean, it can't be both. The reason we get there is because they exclude costs. And recently, to their credit, some executives at these companies have said $6 is really their minimum. I won't harp on this, nor will I read it to you, but this is a very recent list of shale companies published by Bernstein Research, and the column on the right is the one I want you to take a look at. Capex to cash flow. That's how much you're spending versus how much you're making. Imagine if you were running your household at an 860% Capex to cash flow ratio. I mean, you'd probably be, under one of these bridges right now. But there are companies that are doing this, I mean, even the most conservative of these companies, and some towards the bottom they're all above 100%. They're all spending more than they're making. How can you be making a profit if you're spending more than you're making? It just doesn't make any sense. You want to tell me about the future? You're investing in your future? That's another story. I told you these things contract. This was a field, this is the Haynesville Shale. It was supposed to be, 9 million acres. The red is good, the yellow is iffy, the blue is bad. What's emerging here is about 110,000 acres that may have the possibility of being commercial. It isn't today, out of several million. This represents 10% of what was advertised 4 years ago. And again, this was going to be the 4th largest gas field in the world. So it'll be approximately 10 to 15% of what was promised. Here's the mighty Marcellus. Now, this pattern repeats itself. I mean, and just so you know, I'm not picking on shales. This is the way oil and gas plays work. You've got a play, and then within the play, there are fields. And everything in between the fields stinks, okay? It's not commercial. So what we're seeing in the Marcellus is a very promising looking area up in the northeast. It's dry gas, unfortunately. And we're seeing another very promising area down in the southwest and a few little blips in between. The blue, by the way, means that the wells are underperforming what the operators say they will. So I won't harp on that, but this is the reality. Then we got these guys, no fracking way. If you've spent any time in places like Pennsylvania or New York, as I have, whether you agree with these guys or not, you got to take them seriously. My wife and I drove from Cornell up to visit some friends along the Finger Lakes. Every little bitty town that we drove through, every lawn had a no fracking sign on it. So again, whether this is something we should really worry about or not, these people worry about it, and it's going to slow things down. My industry has always done a horrible job of public relations. We're not getting any better. There are other issues. Earthquakes don't help, but that's going to slow things down. Finally, this claim I hear all the time that natural gas is going to reduce our dependence on foreign oil, it's just pure horsepucky. I mean, I don't know, does anybody really believe this? Natural gas was 25% of the U.S. primary energy mix in 2010. Shale gas was 4%. Is this really a game changer? 4% of our energy mix? I mean, it's great. It's good for our gas, but it's not going to eliminate dependence on foreign oil. 3% of natural gas is used for transportation. Okay, now, however hopeful you might be, and optimistic and aggressive, you're not going to go from 3% to 20% or 30% in anything less than a decade. Okay, now I don't mean to throw any cold water on environmental issues. I belong to the Sierra Club. I belong to the Nature Conservancy. This is just reality. We can't make these massive equipment changes overnight. So what does it mean? It means that magical thinking says that we can spend a tremendous amount of capital betting on shale, and much of this in the form of debt. And that's what happened with our subprime issue, okay? We're taking huge risks that weren't acknowledged. Uncertainty equals risk. There's an entirely new paradigm in land and completion costs that's completely changed, and I might add, ruined my business. I mean, you can't go out and buy a lease anymore for $150 an acre. I mean, every leaseholder in the world thinks he can get $5,000 or $10,000, or if he's Dallas-Fort Worth Airport, $20,000. Total just paid $14,000 for an unproven play in eastern Ohio. So the little guys are gone. If you don't like big oil, that's not good. There's very little shale production history, so the outcome's uncertain. It's unclear that shale gas production will support even the short-term expectations of abundance. Capital expenditures exceed cash flow. Full cost and off-book accounting mask the weak performance of many of these companies. There's huge uncertainty about reserves, and most are undeveloped, yet the prevailing view is that success is already certain. And I say that magical thinking can get you into a lot of trouble. Thanks very much.
Okay, I'm Terry Engler. I'm from the Pennsylvania State University. And what I'd like to do is talk a little bit more about the details of decline curves and then look at the Marcellus. But before doing that, I want to spend just a little bit reflecting. And this reflection basically goes back to 2007, Madison Avenue. During the Madison Avenue call-in, I was asked the question, what happens if Marcellus production leads to a glut of gas? In 2007, of course, we didn't know that gas shale was possible. We didn't know what the potential was. And so this question couldn't be answered. And so I told the person that called in, we're going to have to wait. Let's try to get there first, and then we'll see. And so what's happened in the meantime, of course, is that Bentech yesterday announced a spot market price in the near future of $1 per 1,000 cubic feet. So I take that Bentech announcement of yesterday is the fact that we have now got there. It took us 5 years. And this has an impact on a lot of the operators. You can see CHK stock rolling right downhill along with natural gas, although they said escaping the gravitational pull of a weakening natural gas prices is not easy, but we believe it can be done. Well, let's look at the Marcellus production in particular, and I should point out two curves. One is a Pennsylvania gas production. Now, basically, this is a model, incidentally. This is not real data. It's a model. And here we are before the arrival of massive slickwater fracking and horizontal drilling. This is the curve for gas shale, and you can see that basically most of Pennsylvania gas production in the last 4 years has been driven upward by gas shales. And so here's the history, and I'm going to work backwards, reminding you that yesterday was the BINTEC announcement, and basically I think we can call that a collapse due to a glut. Now, maybe that's not the right language, inappropriate in this audience, but nevertheless, pretty cheap stuff, and as Art has indicated, you can't make money off of that. Going backwards, 860 days ago, Madison Avenue rolls out the Marcellus, and I've identified that point in time as the beginning of gas shale production in Pennsylvania right in here. Let's go back further in time. 2,920 days ago, Devon shifts largely to a horizontal program. Art talked about that with his data for horizontal wells starting in 2004. Further back in time, this is the Mitchell massive slickwater frac in 1997. Probably one of the more seminal events, though, occurred in the late 1970s, which was the first horizontal well drilled in Appalachian Basin gas shale. So what we can see is that it took less than 20 years for the price of natural gas not only to stabilize and decrease, but I suppose some would say almost collapse. Look at this curve right in here. This curve, in fact, is the curve for the production of oil from the point of time of Titusville in 1859. In just 20 short years during the period of early oil production, the price had been affected by abundance. And so the question really is, what is going to happen as we move forward? And one of the interesting things, of course, is that this price glut was driven by a sand called the Bradford sand right in here like this. And you notice the Bradford sand declined very rapidly. The difference between the Bradford sand and gas shale, particularly the Marcellus gas shale, is that it's going to continue to climb and climb and climb and climb and climb all the way over to there with time in terms of production. Now, it's correct, Art is correct, that this will require continued drilling. No one has said differently on that, and so drilling will occur in Pennsylvania for a long period of time. Okay, so there have been a number of stories in the New York Times in the last year, many of them not very optimistic. And interestingly enough, I had a meeting with the New York Times who recognized the author of these stories, Ian Urbina, right here. And when I give a talk, I generally have people sign into a notebook. A number of people have already done that. It's this set of notebooks right in here. At any rate, one of the stories was insiders sound an alarm amid a natural gas rush. Oil production and gas production decline rates as a function of time are in question, and the loss of reservoir pressure is the cause of this. This is one of the physics of the process. It requires a pressure drive to continue production at any given rate. So physics of the process is captured only indirectly by decline curves. These are the curves that Art has talked about, and what I want to do is describe what we know in a little more detail. Here's another story by Ian Urbina, Beneath the Veneer, Doubt on the Future of Natural Gas. And one of the important things is that these decline curves that Art described and that I will go into in more detail are based on a paper written by ARPS in 1945, who formulated a comprehensive set of line equations to define exponential, keep these names in mind, exponential, hyperbolic, and harmonic decline. Then in 1983, Fetkevich understood that at least single-phase incompressible fluid production from a closed reservoir is easily modeled by exponential decline. So now we have to understand what's going on right in here. So, first of all, traditional gas is produced from a closed reservoir, a sandstone that has high permeability and very defined boundaries. Here's a boundary here and here's a boundary here. so that as production is turned on in this well bore, you'll notice that the pressure of this reservoir immediately drops at the edge of the reservoir. That's what we mean by an enclosed reservoir. What occurs at the well bore is immediately felt at the edge of the reservoir. This is called steady state decline. Right in here. Steady state decline basically means that the well declines at the same rate for each period. Now bear in mind that because there's a decrease in production from one period to the next, that rate follows it right down. Reservoir is so permeable that high pressure is brought down immediately throughout the reservoir. So keep that in mind. The flow is governed by a diffusion equation known as Darcy's law. All right, the ARPS equation to define that, and I apologize for putting up a couple of equations right here to understand what's going on. This is what it looks like, and that's not really the important point so much as the decline curves look this way. Now, a bunch of engineers and scientists will plot these as log plots right here, so that this is an exponential decline right in here in log space, and this is semi-log space. Now, this becomes very important because some of ARPS diagrams had the production rate, which is this vertical axis right here, plotted in a log scale. The horizontal axis is arithmetic in scale, and exponential decline is a straight line, is shown right in there like that. So what do we learn from this? A standard sandstone reservoir, for example, like the Oriskany sandstone here, can decline with a behavior that looks very much like this. There's a precipitous decline to time in which zero production occurs, and the cumulative production is shown to be achieved very, very early in the history of this particular well. So that's a closed well, steady state decline. Now, what is shale, though? Shale differs from the classic sandstone reservoir. Shale is a reservoir that's known as an open reservoir, where the decline rate decreases each year. And what happens is that when shale production is turned on right here at the wellbore, you can see that pressure drops right next to that wellbore, right in here, but that pressure drop is not felt at the edge or the boundary of this particular reservoir. So that's the distinction. It's as if shale production occurs in an infinitely large space as opposed to a bound space, and this makes all the difference in the world. So what we do then is we can look at these classic decline curves proposed by Fetkovich right in here and see that the exponential decline, which is the bound reservoir, propagates down through here. And again, some variables in here that we don't need to worry about. Other than that, what you see is that if the behavior of this well is something other than exponential, the rate of decline is slower. Now let's go on to the next curve right in here and understand that here's the same set of curves, again plotted in log space, with the gas shale plotted over here on the right in here. And you can see again that gas shale reservoirs or individual wells should last longer than the classical decline curve. Okay, so that's what we're talking about. If we take this same data and plot it as a cumulative production curve, you can see that a dissolved gas drive reservoir like the Oriskany and the Appalachian Basin reaches full cumulative production very early on. Gas shales produce a lot longer. All right, I haven't told you anything yet in terms of total performance. Let's return back to Ian Urbina here. And at some point in June of last year, he said that gas production data reviewed by the New York Times suggests that many wells in shale fields do not level off the way that companies predict, but instead decline steadily. This is the New York Times telling you that gas wells behave the way a classic sandstone reservoir behaves. Now, he didn't know it at the time, but that's in effect what he was telling the public. And so basically production, at least according to the New York Times, is modeled like a closed reservoir here, a sandstone-like decline. All right, what is the reality right here? Well, we go to DeGloyer McNaughton, and on one of their curves, this is a Barnett curve right in here, you can see that they've fit a straight line right in here starting at the end of 20 months. When you see a straight line, notice that this is a log scale on the vertical axis, the production rate. When you see a straight line, that's steady state, or if you like, sandstone reservoir-like decline. Now there is a front end to this curve, which is this decreasing decline as each increment of time goes by. So we want to make a distinction between these two. First of all, there's the division line. There's where DeGloyer and McNaughton put the transition from a steady state or from a fast decline to a steady state decline. So in terms of behavior of this particular Barnett Shale, we see that there's a hyperbolic decline that lasts about 20 months, and then we go into a steady state decline. Now, one of the things that is a detail, I admit, but I think very important on this is that you can see this well right in here. Unfortunately, this light is not quite as good as it should be, but you'll notice that this curve, from the start of this exponential decline, the production curve drops below that straight line, not at the end, but halfway in between. And in fact, as you see, the production comes back above that line towards the end. And some of us, I guess, would interpret that as hyperbolic, not exponential behavior. And we wonder whether even DeGloyer McNaughton got this right. At any rate, let's go on. Here is the open reservoir. There's the closed reservoir. What happened in the shale anyway? This is the way the experts talk about this. I want you to picture 4 wells drilled vertically from a pad and then horizontally side by side. They're stimulated. And here's the well bore is right here. Notice that the drainage area associated with each one of these fracture stimulations does not pinch on an adjacent drainage area. This is the situation when the reservoir is open. The shale drainage will gradually expand with time. This is that hyperbolic period in the behavior of a gas shale well. Then, when the drainage interference prevents further expansion of reservoir volume, this is what engineers mean by a closed reservoir. Basically, the boundary of the drainage area has felt, and that should cause the transition from hyperbolic decline to exponential decline. So this is basically what goes on. All right, now in the Appalachian Basin, going back to the basin, what do we know about the Appalachian Basin? Here's an early paper where a series of wells have been averaged, and incidentally, this is the way that industry does this in coming to their conclusions. And you can see that this is a 1985 SPE paper, and at that particular point in time, the author points out that B is greater than 2, and maybe this is one of the first times that anyone in industry actually pointed out that tight shales behave differently from conventional sandstone reservoirs. Now notice that there's a 40-year period of production data, and that a hyperbolic decline fits that entire 40 years. Now there's a problem in the beginning right here. He picks an initial decline that's too low, and he admits it in the paper, so the entire curve will shift down and over-predict the production of this. But the point here is that exponential behavior, at least presented this way, does not occur out to 40 years. All right, so I have a problem with the state of Pennsylvania, and I talked to the legislators about this when serving on the governor's Marcellus Shale Advisory Commission. Pennsylvania requires that production data be turned in only once every 6 months. And the problem, of course, is you can't make decisions concerning long-term decline with very few data points. Right now, there are only 3 data points out. There will be a 4th one shortly. But with 3 data points, you can't do what can be done in West Virginia. Here's a set of Antero production data curves compared with a Marcellus pro forma curve. And what you see largely is that so far the data for Antero and Harrison County, these are all horizontal wells, is performing better than the Marcellus pro forma curve. Looking at the cumulative data. So I went to another county and picked some wells, and these are vertical wells, it turns out, rather than horizontal wells, but nevertheless, when you accumulate these, average the 8 wells, you see a repetition of the Van Orsdale data. So, with Chesapeake in Marshall County has some horizontal wells, and again, you can compare the performance against the Chesapeake pro forma decline curve. So you understand where the pro forma decline curve comes from and what constraints are put on it. All right. In the Pennsylvania Appalachian Basin, right in here, the production is largely constrained by the presence of delivery infrastructure. And I should point out that there's a pipeline that goes right through here that's called the Tennessee Pipeline. Now, Art, I take a little exception to what you said about these areas being underperforming. Those areas are not underperforming. They're just not connected with infrastructure yet. And what you see right here in the southwestern portion of the state, again, is infrastructure an infrastructure delivery issue rather than performance itself. There are a few wells right in here, but with those few tests right in there, there's very little that's presently hitched up to high-pressure infrastructure that can deliver the way that it's supposed to. Eventually. So let's look at some production data that I've acquired. Basically, what you have to do in Pennsylvania, if you really wanted to study decline curves, is you've got to go door to door knocking on the doors of the local farmers saying, can you please share your production data with us? That's the only way that we can get at it. So I found a farmer named Smith who was willing to share 3 production curves right in here. Notice that Smith's curves go out to 21 months. Right in here, and at least for the first 21 months, what applies is the Texas A&M power law exponential decline curve. And basically, the folks at A&M have pointed out that in fact a single B value for the hyperbolic decline doesn't apply, but B itself evolves with time. And the purpose of this particular modified power law loss rate decline is to compensate for the fact that B, the characteristic of the hyperbolic decline, evolves with time. So if you take the Texas A&M modification to the ARPS curves and apply it, here's one of the Smith wells, for example, and what you find is the initial production on that well was 8.9. This is a monthly daily rate over the period of a month, so it's a practical initial production, close to 9 billion a day for that month. And with the Texas A&M modification of ARPS, then the total EUR of 8.6 billion. And this is the reason industry is optimistic about the Marcellus. Here's the cumulative decline as we know it right now from Bradford County. And again, applying the Texas A&M equation right there, the average well has an initial production of 4.5, and that'll lead to a cumulative EUR of 6.7 billion per well. Now, of course, bear in mind that this is the best that we have right now in terms of an ability to project forward in time. Okay, just a couple comments. Why are the Marcellus wells better than the Barnett wells? One of the things that we've found is that the Marcellus in particular is so heavily fractured relative to the Barnett that allows greater access to deeper portions of the reservoir. This is a well drilled in Marcellus here, and you can see that fracture pattern. So, reasons for long hyperbolic decline in the Marcellus: horizontal wells have access to unbounded reservoir in the vertical direction. All right, so that raises another particular issue, which is not only is the Marcellus charged with gas, but the Hamilton group, which sits above it, is charged with gas. In fact, as we've learned from Rob Jackson with his study, that in fact the entire thickness of the Devonian section above the Marcellus is gas charged right up to the surface. And this is one of the problems that we got into with Demick, is that an early operator naively drilled into this exhumed gas field and didn't deal with it in a way that probably should have been dealt. All right, natural fractures allow access to a much larger reservoir volume, and drainage is far more complete from a naturally fractured gas shale. That's probably what sets the Marcellus aside. Thank you very much.
Thank you. Okay, so these are really critical questions. I'm glad to be on this panel. I'd like to take it, or add to that, by talking a little bit about the industry dynamic and the way that some of these plays develop and some of the important issues that we see. As you think about this, you hear a lot of news about the shale. How do they develop, and what are some important issues to be thinking about? So this is a map, if you will, of the great state of North Dakota, and these are all the Bakken wells, all right, that run through the middle of the summer, essentially. And what we have here, then, is it's a heat map. And the hot wells represent the better wells. Now, I'm using the peak production, which comes early in the life of the well, to represent sort of a proxy for the near-term and medium-term production of the well. All right, so you can think of basically the wells that are red as the best wells, all the way down to the gray wells, which are the lowest productivity wells. Now, I want to make a couple of points here. Number one is it's important to understand that every play benefits from what I call engines of growth. And there are three main engines of growth, in my opinion. Number one, well sizing. Well sizing is essentially just how far laterally are we drilling, okay, and how big the wellbore is maybe. The second engine of growth is rock productivity and our ability as an industry to intelligently get more out of each foot of rock. And then the third engine of growth is above ground efficiencies, which comes down to drill days, doing it cheaper, doing it smarter. And what happens in plays is when, particularly in the first and second stages of the play's life, those things compound and you get enormous sort of explosive growth. You're drilling longer often, you're getting smarter about how to get it out, and you're reducing your drill days. So one rig can all of a sudden produce quite a bit more. That's the first point I want to make, is we have engines of growth. And just showing an example of that, we're currently showing the peak production, as I mentioned, from here. I'm going to switch now to lateral length, okay? And what you can clearly see is the pattern changed dramatically, right? And what you get is some very different results. So we're looking at lateral length, how big are these wells. And what you see here, just take a look. Well, how long are these wells? The longest 20% of wells in the play are, I don't know, grab most of those, around about 15,000, 17,000 feet, okay, of lateral length. Sometimes that's two well bores in the same vertical well. Now, that compares to, let's say, take it down here, the shortest wells, which tend to be 4,000. So you can see a very dramatic difference there between people who are drilling very long and people who are drilling very short. So when we talk about rock productivity, which is what I want to focus on today, we like to use peak production per lateral foot, okay? And so let's go to that now, all right? So now the second point I want to make today then is within this sort of distribution of well productivity, if you will, how much different are these? How much natural variability do we have in these plays? And I'll tell you what, I'll give you the answer and then I have a quiz for everybody, all right? So pay attention. It's a quiz. The best 20% of wells, in terms of the peak production per 1,000 lateral feet, comes in different companies. You can see come in different levels, but essentially a good proxy for this is 125, okay? So if a peak 20 top quintile wells, 125, let's just go for the next quintile, okay? So everybody who thinks the next quintile is between 100 and 125, raise your hand. Between 80 and 100, raise your hand. Between 60 and 80, and less than 60. Okay, let's see. The next best 20% of wells are roughly, grab those, tends to be pretty, it's only about 60, Okay? So what that says is being in the top 20% gets you a well that's roughly twice as good as being in the next quintile. And I won't go through all the quintiles, but I will go down to the last one. And remember, these are, we'll turn off our verticals here, but there's only a few in this play. So on, a peak production per lateral foot basis, we're talking about this. Roughly, I call it 12.5 because it's 1/10, okay, the top quintiles. So the second point I want to make is that there's an extraordinary divergence within a play, extraordinary variability between the very best wells and the least productive wells. Now, the third point I want to make is let's turn everything back on, and I want to talk about one specific company in this context. Let's focus on this sweet spot, because frankly, if I look at all the wells in the play, roughly 80% of the wells are in this, the Parcel Sanish area. And I want to focus here on EOG, and I want to take you through the time dimension of how the play developed for EOG, who was the leading operator in the play for quite a long time. So come here and watch. You can watch the movie as we go along here. And okay, so you can see they start up there in Mount Rail County, all right? And they're doing well. In fact, very consistent, okay? They go on, and look at this. I mean, by the time they get to 2007, 2008, it's looking very good. And then I want you to look starting right now. And watch this little hole. See that little hole? Okay? Watch that as time goes by, and watch what the company does in terms of where it's drilling, okay, as time goes forward. And you can see, right, bigger and bigger and better. So by the time we get pretty close to the present, you can see that the company has essentially moved completely out of the core area in which it is, and in the process, drilled a number of wells which are not as good. All right? So if we take a look at the record of this company over time, what you see is this. So well productivity for EOG collapsed by about 70%. Now, did EOG do anything wrong? No, absolutely not. Okay? They had the best part of the field. Those are the very best wells in the field, and they did what every company ought to do, which is drill your best stuff first, and they drilled it. But eventually, you can only put a certain number of wells. Okay? They made a lot of production out of this, and eventually they were forced into other areas, and frankly, they didn't necessarily own good acreage in those other areas. This acreage up here is not all that attractive. Now, that's my third point, is that sweet spots do have limits in terms of the number of wells you can drill in them, and we tend to drill them first. Now, the last point I want to make, though, is that these plays are ongoing technological wonders, in my opinion, but ongoing technological efforts. And if I look at this, and let's take a look at where everyone is drilling in the play. So I come here, and you can see the whole play. Right here, you can see people are drilling on the other side of the anticline, a little bit over here. Nobody's really discovered Mount Rail here. This is really early days. By the way, Halliburton drilled the first well here to try to prove up horizontal technology. And you can see here clearly they're in a space where they are drilling very much in Mount Rail County or the best wells. Now watch what happens. This is fun. It's almost like a cannon explosion in the next couple of years, okay? Okay, see that? Isn't that pretty interesting? Okay, it exploded westward. What's happened is, as we filled up the best part of the Parshall, we've migrated in search of another sweet spot. Okay? And that's very important. And the interesting news is that while there will be some limitations, technology is also changing, and people are getting better at doing things. And frankly, when you have $90 or $95 prices, you can afford to take the kinds of risks that generate knowledge and learning. And so, if we get rid of some of the noise and just focus on the best wells, it looks to me like there's another sort of potential emerging core coming sort of in a kind of arc like this, okay? Now, someone could prove me wrong, and either that will start to fail or we'll find other places that are better. But my point is that in addition to sweet spot exhaustion, there is potential for sweet spot emergence, okay? So life is tough in these plays if you're not in the sweet spot. There's a chance to find more, but in general, everyone is engaged in trying to get to the better wells and the better acreage in the play. So that's just a couple of thoughts on thinking about these plays is we discover it and they pass through the phases from the initial proving through the optimization phase, and frankly onto the big, long third stage. I think of it like life, right? Plays are initially kind of children, and then they move to high school and college, and then they graduate for that long period of their life, you know, the 40-year one where you go to work. And frankly, we have a lot of shale plays that are just entering that. They're graduating from college, they're optimized, we kind of know how to do them, and we'll be drilling for decades in some of these, all right? And so we think that's a helpful framework for understanding some of these plays. Thank you.
Okay, I'd like to open up the questions to the floor. So if you have any questions, please approach one of the microphones.
You've got such an optimistic view of the shale gas. I'm sure while listening to that, you must have heard what are these people talking. Now you are giving totally different view, like the industry seems to be going the way like housing crisis. I don't believe, why will the major oil companies do like what you are talking about? If the $7 is really the break-even price, can you explain why we are seeing $3? That is number one question. And if you can explain that one, can you also tell, like Mr. Sharp said correctly, that we always see that things change for the things we do not expect today. So what is that things which are going to happen which we don't see today to change the pricing scenario in the future?
To answer your first question, my background is in geology and not abnormal psychology. I can't explain to you why people do what they do, but let me make an attempt. Contrary to what we read in the newspapers and what we hear on television, which says that we've got plenty of oil and plenty of gas and we're just going to keep finding more and the technology is going to save us and that price is going to save us, I'm here to tell you that as somebody inside the industry, that's simply not true. And you know, Terry showed some of the oil decline curves from Pennsylvania. We peaked out on our oil production in the United States in 1970, and even finding giant fields like Prudhoe Bay didn't change it. Okay, so we're dealing with a limited resource, and we are at the bottom of the barrel. That's what you're seeing. The shale plays are being pursued because all more attractive opportunities have been exhausted. We're drilling, what did you say, 15,000-foot laterals. I mean, this is desperation, people. I mean, you know, there was a time not terribly long ago when people who didn't have degrees in engineering and geology could say, you know, there's a hill out there and I think I'm gonna chop my way down, and they found oil fields. I mean, most of the big oil fields, the East Texas field, for instance, were found by relatively unsophisticated people because it was easy. That's what I'm saying. It's getting harder and harder and harder, and yet the stories that we hear is it's just getting better all the time. And I have a hard time with that. I think that depletion is an inexorable fact of physics. Yes, we can find new ways with high prices and very expensive technology to squeeze more blood from the stone. And I don't want to get into a peak oil kind of discussion here, but I mean, I think that what you're seeing is a dichotomy that ought to cause concern. I'm not saying that I'm right and everybody else is wrong, but I've been doing this a long time, and I think some people take my opinion seriously, that things are not as good as they seem. A sweet spot is nothing but a field. We've known about fields since Titusville. The whole world isn't good. There are very small areas of plays that are fields, and the rest of it is not very good. That's my answer. I look at data. I don't look at models. I'm an empirical person.
I'm also looking at the data. Why would any oil company go on spending money like this when they don't recover their marginal cost? I mean, one need not be a psychologist to figure figure that out. One has to be an economist. Why will they spend the money? That's what I'm still trying to answer. And I didn't get the answer from you. It's just like you are telling that, yes, but why? How come gas price today is $3 when you are showing it is $7? And some people are telling that because they are making money by selling the liquids. Is that case? Is that the reason?
If they're in a play that has liquids, then that certainly helps. There's no doubt about that. The plays that I talked about, the Barnett and the Haynesville, the Fayetteville, those are pretty much dry gas plays. So there really isn't that outlet. I do a fair amount of economics, even though I'm not an economist, and I think if you talk to most of the people that work in these companies, they will tell you that they are losing money at these prices. They have strategic reasons that they want to hold acreage, or that they want to, they see higher prices down the road. They want to hold it by production. I mean, there are many reasons. We can discuss what those are. But profit, or certainly short-term profit, is I don't think you'll find too many companies that are saying they're making money at these prices.
Art, could you respond to Terry's point about the Pennsylvania play not underperforming? And he argued that what showed up as blue in your map was heavily influenced by the pipe lines and hooking up wells. Could you respond to that
Sure,
one
John.
specific point?
Yeah, I didn't explain the map. I agree with Terry, first of all, that Pennsylvania, I mean, some federal agency needs to talk to them about interstate trade. They really do. I mean, this is ridiculous that they release production data in 6-month tranches. There's no state in the country that does that. It prevents people like us from doing a third-party objective analysis. The map that I showed you, what it does is it's based on a type curve, as much as I despise type curves, but that's all we got. And what Pennsylvania tells you is what the cumulative production is based on a certain number of days of production. So you can go out on that x-axis, that arithmetic x-axis, however many days the well has been on, and you can go up to the curve and see if the cumulative amount that's been produced is performing at the curve, above the curve, or below the curve. Now, it may very well be that there are infrastructure issues in that blue area of the map, but the state of Pennsylvania, the DEP, is reporting production. And they're reporting a certain number of days and a certain volume, and we're comparing that to where a well should be at that stage of its history if it's going to be commercial. So I can't, I can't justify how those numbers are arrived at, but those are the numbers that we get from the Pennsylvania DEP.
I actually have a question that hopefully that all three of you can address to some extent. In particular, and I've looked at some of this well file data as well, what have you noticed with regard to the evolution of EURs for, say, type wells over time? And what do you think that portends for these plays going forward? In particular, to lean on a point that I think Raul made, there's a little bit of learning by doing that appears to be going on in these shale plays, and how does it affect some of the things that you're addressing, Art?
Well, I think what Raul showed was absolutely what we see in all oil fields, that you usually find the best fields, the biggest fields first, and after that it gets harder and harder to keep up, and if you can find another field or another sweet spot, fine. So what I see in looking at the longer term production, say in the Barnett or the Fayetteville, and by the way, I fully take Terry's point about the fact that the Marcellus is very likely different, and I think he's done a lot of work on that, and I'm certainly optimistic that he's right, and other people are too. But what we see in these other plays is that the estimated ultimate recoveries are typically from the older generation, it's so young. I mean, 2007 is an old vintage. Once they figured out how to do the horizontal drilling and the multi-stage fracturing, and what's happening now is companies are spending tremendous amounts of money on these, on these very closely spaced wells that are having very good initial production rates, but I think their drainage area is either limited or they're drilling into areas that have already been depleted.
Terry, do you have anything to add?
One of the things that becomes very important in a lot of these plays is trying to define the ratio of gas in place as opposed to that which is ultimately technically recoverable that gets moved into reserves. And a number of the companies are publishing figures that approach somewhere on the order of 40% of all gas is recoverable. And I think that 3 or 4 years ago when I sat down and thought about this very carefully, I had the figure at about 10%. And as we move forward in time, the ability to get at a larger fraction of the gas that is within the defined unit, the unit for a 4,000-foot lateral might be 80 acres. It's going to be very important to be able to drain that particular 80 acres, and it's not clear to me right now that people are getting at anywhere near 40%. And so when the technology evolves, I'm an optimist, so that I believe that eventually there will be a process by which the rock can be broken apart so that this amount of gas can be recovered. Why then what you'll find is I think very profitable wells, as long as the price of gas doesn't stay at $1 a 1,000 cubic feet. Of course, that's makes all the difference in the world, and that's a policy issue that the Baker Institute ought to look at or consider going forward. What happens if gas stays at that price? Because clearly no one makes any money, and Madison Avenue doesn't have a return on their investment, and that has implications.
Raul.
Sure. Yeah, I just want to make a few points and to Terry's last point. Yeah, nothing solves low prices like low prices, right? So I'm not too worried about that. If nobody's making money, it will change. But just a couple of points I wanted to make, going back to Arthur's point about these wells being kind of desperate and pathetic wells. It's true, okay? On a global scale, a shale well or a tight gas well or an unconventional well is nothing to write home about. It's not really good. So why is this happening? Why is the world, coming to North America? And I would say two things. Number one, it's important to remember what's going on in the rest of the world. And in my mind, the rest of the world in the last decade has reversed very strongly the opening trend of the 1990s and has shut off. So you have companies who have oodles of cash at $90 oil and absolutely no place to spend it that can take that kind of money. And your choices are, I can blow out my brains on a bid round in Algeria or Nigeria or Libya, or I can go somewhere and get kicked out by creeping renationalization, a la, say, Russia or Brazil. And none of that really works. And what it discovered is I can go to one of three frontiers. I can go to an economic frontier like an oil sands, or I can go to a technological frontier like ultra deep water, or I can go to this new sort of frontier, which is shale oil and gas. And the beauty of it is not only, of course, the liquidity and the ability to get in and do deals, but, if you think of the resource pyramid, this is the more difficult stuff to get. It's not that great, But what has happened is that the price, first of natural gas and oil together and still of oil, went, frankly, so high that it allowed people the freedom to go and experiment, to go and figure it out, and you know what? They did. And it worked so well that we flooded a regional gas market. We're finding a whole bunch of liquids plays. Right now, I would argue no new gas plays have been found in the last 3 years. However, I can name 5 or 7 emerging oil plays. Why? Because the risk-reward ratio works. And so, that's what I think is happening. It's completely related to price. If the price allows you to go try a bunch of things and go get this inferior resource, people will go for it. Okay, there's a big prize. And what I find interesting, in contrast, I'll pick on oil sands here a little bit, which is a great resource, but I would say this: 10 years ago, oil sands worked at $70, and today it works at $70, $65. Whereas what's happened, I think, on the shale side is that we went for this big resource, and initially it took a lot to do, okay? And some of it still takes a lot to do. But we also generated an enormous amount of efficiencies, an enormous amount of knowledge and learning, and there's reasons for that, that allowed us to bring that threshold price down and get to a better level. So high prices have done this. In my mind, you got the peak oil argument on one side, you got the economics argument on the other side. I would say it's maybe 1-to-1. It's gas. It's certainly economics has worked. Oil, I'm still not sure about.
But I think it's important to understand that when you read things, as we often do, that the United States is going to surpass Saudi Arabia and Russia as the leading producer of oil by 2015. I mean, we read this in the paper 2 weeks ago. That's assuming that every acre of the Bakken Shale is going to produce as well as Parshall Field. If it did, then they'd be right, but it isn't and it won't. Okay, so those kind of numbers are suspect. The other thing, back to our first question, I think the simple answer is, if you're a major oil company, Raul's got it nailed. It's all about reserves. You've got to do something to grow your reserves, to keep your stock price up, and to make sure that people don't perceive that you're actually liquidating your company. And so when ExxonMobil bought XTO Energy, they were able to replace reserves that year. If they hadn't have bought it, this is according to the Wall Street Journal, it would have been the worst year for reserve replacement in the history of Exxon. Okay, that's what we're really talking about here. And we're also talking about companies needing to perpetuate the idea that everything is great and that they're growing their companies. The third issue, and it's easy to forget how fragile the world is economically. Everybody's looking for hard assets. The United States and Canada are just about the only places in the world where private ownership of mineral rights is allowed. Okay, you want to go to Poland? That's great. Deal with the Polish government. They're going to give you a concession. If they do, one company has to de-risk a whole basin by themselves. That's a tough row to hoe. Okay, so energy, the world needs energy. The world is investing in the United States and Canada because they perceive that to be a commodity that will always have value. And then other parts of the world have inflation. And other parts of the world have no natural gas or oil, like in Asia. It's a strategic concern for them. So there are many reasons.
So I have a question, Arthur. You're making this statement that as if the history of the oil industry is, we went to the North Sea, the first field we found was really giant, and then we found smaller and smaller fields, and that's not the case. And then we went to Gulf of Mexico deep water, and we found smaller and smaller fields, and the history of Thunder Horse and some of the later finds shows that that's not really the case. Not going to be the case in Brazil. So are you saying that there is something that's so dramatically different about shale, that the first lucky guys who found a sweet spot in a particular place, when we're just learning about a play, means that we found the totally biggest production areas now, and that 5 years from now, we're not going to find any other big production areas? Is that because there's something for you and Terry so different about shale than everything else the industry's ever done, that, there's something that just all the other things that's ever happened in oil and gas exploration is going to turn out not to be true?
Well, the straw man is the assumption that the North Sea didn't go in decline early in its production. You said that's not the case, but that's absolutely the case. The case is that the Gulf of Mexico has been in decline for decades. And if you look at what the deep water did to the Gulf of Mexico production, it did precisely what Prudhoe Bay did to the entire U.S. oil production. It was going down, down, down. It went up a little bit, and then it went back down again. I mean, show me a basin in the world that once it begins decline, does not continue to decline. North Sea is the classic case. So I don't accept your premise that those basins, you know, somehow have reversed depletion, because they simply haven't. Is shale different? If you listen to what I said it's exactly the same. There are plays and there are fields. The laws of physics apply whether you're talking about good reservoirs or really lousy reservoirs. Accumulations exist for reasons. They're not factories. We like to think that they are, but they're not. And so I'm saying, and I think Terry's saying too, that, and Rahul too, that no, I mean, shale is just a worse reservoir, and it's what we have left. But the physics of it are very, very similar to better reservoirs.
But you're basing something on an order. You're saying that we always start with the very biggest field, and then we go smaller and smaller over time, and that's not really the history of the industry.
It absolutely is the history of the industry. I mean, that's exactly what happens. That's not my opinion. I mean, that's hard data. I mean, we can talk about this later, but I'm really interested to see, you know, what kinds of production data you're looking at that suggests that, I mean, this is just statistics. I mean, this is a tremendous body of literature and study on the oil and gas basins of the world that shows that it's always that way.
I think, just to offer a clarification, I don't think what Amy was saying was that the North Sea hasn't been in decline since it began to decline. I think what she's saying is that we actually went into a province and we found oil that we didn't think was there before, and that actually led to a short-term increase in production. And she's asking you if we might not see the same sort of phenomenon with shales around the world, not just within a particular basin.
The idea that we find a 100 million barrel field, and then the next field's 50 million. Like, I understand average over time, you're going to have a decline rate for profits when everybody goes into drilling, right? But this idea that the industry is so perfect that we pick some spot, you know, the Haynesville say, and that's the best sweet spot that we picked, and there isn't another one out there, and after 20 years of exploration, there's not going to be another sweet spot left in the country from the first three we identified in 2003. That seems not in line with the history of the industry.
Well, I allowed that Prudhoe Bay was discovered late in the history of U.S. oil exploration. I allowed that Thunder Horse was, but all I'm saying is it doesn't materially change the fact that we're down the resource pyramid, as Raul said. And, you know, can we hope that there's something more out there? Well, yeah, we all hope. I mean, I'm in this business. I've got to be optimistic. Do I really expect that there are going to be tremendous new reserves of oil discovered in the United States, the most mature province in the world? No, I don't. I hope so, but I don't think so. Or are we going to find more resources in other countries? Well, sure we are. But there's a patient man who's been waiting there.
No. Let you ask your question, and I'm going to take a liberty to ask the final question. So,
Raul, there's something you said that I've been thinking about for some time. That the cure for low prices is low prices, and I'm wondering if you invite your speculation and other panel members regarding sources of supply that are either utterly or to some degree insensitive to the current price signal they're getting from the natural gas markets, and that's where the statement was made regarding no new shale gas basins being developed in the last, or discovered in the last 3 years, and that's the magnetic attraction of the liquids-rich inventory in companies' supply, and that it's the liquids that are sanctioning the drilling decisions, and then the gas is a disposal problem in that case. So there's supply that's coming to market of unknown dimension, and maybe you've got some information around that. The other element that I find surprising anyways, coming from international space and relatively recently getting into North America, is the level of HBP drilling that's still occurring, even in some of the gas plays. And again, it's the previous capital commitment is driving the drill decision to retain the lease rather than the price of the revenue stream, the prospective revenue stream. And then finally, a little bit of a nuance. When many of these JV deals that are done, you've got significant disproportionate funding of near-term drilling decisions, so that the operators making the sanction decision is funding 25% of the capital in some cases. So to the extent that these different drivers or elements may be contributing on a near-term basis to the oversupply, and how that might play out. That's what I'd be interested in hearing about.
Sure, 3 quick things then. Okay, so JVs, yeah, you're absolutely right. In fact, after about the first 5 of these JVs came down, I said, this is kind of crazy, because when I hear a JV, they're all structured in the same way. The funder comes in and they promote the operator, and a lot of the JVs, it's the cost of entry, but it's a very expensive cost of entry. And whenever you have promoted economics, you have a divergence of prices. So if the well breaks even at $4, all of a sudden now the funder doesn't break even until 7, and the operator breaks even at 1. Okay, those are some real numbers, by the way. And so that has been, and for the next year or so, we'll continue to supercharge a bunch of them, and unfortunately for the gas market, they're in the best place. Okay, so you're drilling your best wells on other people's money with very low break-even prices. Number 2 was trash gas was first, and number 2 was
HBP.
What?
HBP drilling.
HBP. Yeah, I'm not as big a believer in the HBP theory. There's a theory that I have to drill because otherwise I'll lose this acreage because I leased it, and my lease is going to expire without having established production. I tend to think that actually, if the, as I say, if the HBP ferry came one night and said to all the companies, okay, your land is all HBP'd, I think you'd still get a lot of drilling, because honestly, I think that the drive to grow is a very powerful motivator for these companies, okay? But undoubtedly, there's some HBP. Again, that will also fall off. Third position, trash gas. This is the idea that I'm just drilling for liquids and I'm generating a bunch of gas, so I just throw it on the market. We've looked at that, and what's interesting is if you look at the amount of gas thrown onto the market by new wells, and you divide those new wells into dry gas wells and then wet gas, we call it gassy oil and oil, the portion of gas each month thrown onto the market by dry gas wells, even right now, is about 85%. Okay, so in other words, the overwhelming majority of gas coming onto the market is actually coming from dry gas wells. Now, granted, the other portion's growing, okay, but even so, it's a little bit of the tail wagging the dog, so we see it as an aggravating factor and not a primal cause. So that said, you know, yes, there are a whole bunch of aggravating factors right now, some of which will heal. It takes longer for the market to fix itself, but you know, we continue to think it will happen.
Thanks.
Okay, I'm going to take the liberty to ask the final question. It's really geared to get you guys to try to make a forward-looking statement, if you will. 20 years ago, nobody was really even thinking about shale. Geological, we knew about it, but in terms of it being actually a productive asset, it's not something that we really thought, you know, in mass about. Yet today, here we are talking about a resource that represents on the order of 30 to 35% of domestic production now, and a lot of that owes itself to you know, process and technological innovation. And so what that really speaks to is that those innovations have driven down costs to a point that it made it seem worthwhile for operators to venture into this new play. So I want to ask you to look 20 years ahead and imagine a world, or imagine what the world might look like given the pace of innovation we've seen in shale, given that it's a relatively still a virgin play. Where might we be 20 years from today, and where might break-even costs potentially sit, recoverability factors could potentially sit, and what sorts of discussions might we be having about this resource?
Go ahead, guys.
Actually, let me not be an expert at looking into the future, but let me jump back to the Carter administration and the Arab oil embargoes of the 1970s. The response of the federal government, first of all, was to take an old agency called IRTA and create a cabinet-level position called DOE. DOE's response, one of the first responses, was to set up a project in the Appalachian Basin called the Eastern Gas Shales Project. And in fact, it's the Eastern Gas Shales Project that had the vision that gas shales one day would become profitable. And this particular process went on 35 years ago. It was the technology generated during that Eastern Gas Shales Project that George Mitchell was able to take advantage of. He hired geologists that had experience in the Eastern Gas Shales Project, so that in a sense then, looking forward in time, I would argue, is critically dependent on subsidizing energy industries. And the extent to which an energy industry is subsidized may correlate almost directly with its success 35 years into the future. So that if you have a vision for green energy, it's incredibly important that at some point this be subsidized, and that will lead to the success 35 years from now. In terms of the use of gas, it's very clear that someone has to step forward and create a demand to take up this particular supply. And so where can the gas industry be subsidized effectively to create this particular demand? In the state of Pennsylvania, for example, we've talked about installing compressed natural gas stations along the interstates and along the Pennsylvania Turnpike, for example. This will require subsidy at either the state or the federal level. And this is a situation like the baseball player. If you build the field, they will come. And in a sense, this is the process, I think, that needs to take place to create the type of demand that will continue moving the gas industry forward in time. But without this type of federal forward-looking funding research, if you like, at universities, subsidizing some of these projects, such as the Department of Energy did in the 1970s. Without that, I'm not sure that we have a future to look forward to. It's like the past has been, putting us in the position where we are today relative to gas supply.
I think as long as energy companies continue to squander and destroy capital at the rate that they have for the last 5 years, there won't be much sympathy for subsidizing them. When you go out and spend $20,000 an acre, or $14,000 or whatever, you know, you're really, in my opinion, you're abusing the capital. I think that the shales are certainly a permanent aspect of the horizon, of the landscape of the domestic oil and gas business. I think they're a late stage artifact. They'll be with us for I don't know how long. My own view is that I think that their decline rates are already evident. The liquids are going to be faster than the gas. But your questions about gas, you know, I think LNG is probably what we need to be looking for. Just this morning, you know, yet another enormous gas discovery off of Mozambique. This is, you know, like Anadarko's fourth or something. There's a lot of stranded gas in the world. I was just up in Anchorage 2 weeks ago. You know, they got 26 TCF of gas stranded at Prudhoe Bay. I mean, it's already been drilled and developed. The problem obviously is getting it to market. Is LNG the way to go, or is there some sort of, you know, gas to diesel that can? I don't know. I mean, technology obviously is part of the key, but I'm not as optimistic as usual as many of my peers that in a very mature industry, oil and gas exploration and production, in the most mature province in the world, that we're gonna figure out ways in a cost-effective manner. We've got to compete. We've got to compete with all this stranded gas, and our cost of supply, however you want to cut it, is high right now.
Roll.
Sure. I guess from my point of view, I don't think we have a molecule problem. Right? Going back to the resource pyramid, the point is it's pyramid shaped. Okay, and every time you go down it, the resource gets enormous. Okay, and you know, so one day there's gas which we call the frozen gas under the sea.
Hydrates.
Thank you very much. Lost that word there for a second. There's hydrates. There's that crazy stuff out in Utah, which is almost unbelievably gigantic. Okay, so I don't think there's a molecule problem. That said, I also believe in an overshooting model. In which, in order to go get that, the risk reward needs to be pretty good. And I believe current prices, particularly on the gas side, are probably unsustainable, sustainably low. But again, if the size of the prize gets big enough, I believe that in the longer run, we'll get technology, and in the shorter run, in the long run, you'll get better non-fossil fuels probably. Okay, so I think you'll get that. So I'm not very pessimistic about the future. There will be periods of pain where, as in 2000, 2005 in the gas market, the only thing that kept gas prices down was somebody went without. Okay, it was a demand-driven, demand-capped market, and there will be times like that. Get ready for them. Be ready for them. But I do believe that the actual distribution of hydrocarbon molecules and other energy resources is such that they are adequate for sustaining the sort of path of development. They may be expensive, and we'll have to get there, and they're going to require a lot of hard work and technology. But in the long run, that's where I think I'm not too worried. I'm not a believer in the sort of peak oil argument.
Okay. Thank you. I'm going to have to cut it there. We have a coffee break. I'm sure they'll entertain your question after the break.
It's not a question. It's just a statement. I would like to say thank you very much to the panel. But to break up the doom and gloom a little bit, I come from an independent operator in the Eagle Ford. We started off very small. We've been there for 30 years, and we still find it economical. And you just have to change. There's a lot of other factors that come into play. What you get your lease for and vertical integration. So it is possible. That's all I wanted to say. Thank you.
Thank you for the comment. If I could ask everybody to give our panelists a round of applause. Thank you.
Likewise.